Hello, we have with us Professor Douglas Diamond, who won the 2022 Nobel Prize in Economics for his path-breaking research on the role of banks in the economy, especially in the times of financial crisis. He received the prize along with his longtime collaborator, Philip Debicki, and former chair of Federal Reserve, Ben Bernanke. Welcome, Professor Diamond, and heartiest congratulations on the Nobel.
Thank you very much.
And thank you for taking time out to speak with us. Today we are, meeting ahead of the important Fed meeting tomorrow, in fact. So I just wanted to start the interview with a question on that. What are your expectations and advice? Do you think Fed should increase the rate aggressively or slow down on its rate hike?
That's actually a difficult trade-off. First, let me say I'm not a monetary economist. I'm a banking and microeconomist. But actually, when I was in graduate school, I was training to be a macroeconomist, so I do know something about it. So I can tell you that once inflation has got to the level that it is right now around the world, it's very important for central banks to do something to get people to expect the inflation to not go on for very long. Otherwise, it sort of feeds on itself. People expect more inflation, so they ask for higher prices and wages, and it gets self-fulfilling. So they need to worry about that. And for the way monetary policy works these days, that means they have to raise interest rates. I like to think about the thing that really causes inflation or causes stimulus is the after inflation interest rate, the real interest rate. So basically, they have to raise the real interest rate above what it was, say, a year ago, when it was like -1% or -2%. That's a very, negative real interest rates are really pushing the economy. So they need to raise rates to raise real interest rates, and because there's so much inflation, they have to build in a margin above the real interest rate to raise the real one by raising the nominal one before inflation interest rate. So that said, given that there's so much inflation and so much fear that it might be 10% or 15% or something if they don't do something about it, I think the core inflation rate in the United States, the one they like to use, is like 6% or less. So it's not as bad as the one that includes energy prices and all that. So they have to raise it. Okay, so that's just standard macro. So here's what I can add to that. That there's also this issue of financial stability. So if people, let's say firms or financial institutions who aren't necessarily commercial banks, just financial institutions in general, who borrow a lot with short-term debt, find that their cost of refinancing, rolling over that short-term debt gets really high, then that could cause financial instability. So that the Fed or central banks anywhere need to be measured in how much they do in raising interest rates and fairly predictable. They want to have them know sort of that what's likely to happen the next time and the time after that. So I think so far the US has gone just fine raising interest rates 75 basis points a meeting. I just think they could probably do that this time without a problem because the market seems to be pricing that in and expecting it. But at some point, when they're pulling liquidity out of the system, which is what raising interest rates does, they could start to cause a crisis. And they have to think about, they have inflation as their goal, they have full employment as their goal, but they really have financial stability as their goal too. And they got to think about all three. The good news is, particularly after 2008, they think about that. We saw problems in the United Kingdom, or these things called liability-driven investment subsidiaries of insurance companies, where rapid raises in interest rates cause what are sort of like margin calls, where you have to come up with more money. And so it was actually a collateral call on a swap. So we saw already, that's sort of the quote canary in the coal mine, that we saw already in the United Kingdom that raising interest rates unexpectedly too fast could be a problem.
Right. Good evening, Professor. This is Manojit, Saha, and Veenu's colleague. I would like to ask you that there is increasing social media over the last few years we have seen. So does social media play a role in adding to banks' vulnerability?
It could. There has not been a good empirical study of that in recent years. There's a paper co-authored with Professor Manju Puri from the Duke University Fuqua School that looked at actually bank runs historically in India and looked at sort of the old-fashioned kind of social network, who talked to whom, to see who was learning that the bank might be having a run and caused them to join the run, and she found with a co-author that was quite important. So that's a hint that social media could make contagious fear more of a phenomena that could bring down a bank that had no other reason to go down except fear of fear itself. So I think that could be a problem. I have not seen a study of that. The one thing I can tell you that would push against that a little bit is that the runs that we saw recently, 2008, 9, 10, and the ones we saw a little bit in 2020 in the early parts of the COVID crisis, those runs tended to be among institutional investors, big professional investors, not between people like you and me. So they're much less likely to have social media be the thing that's having them communicate. They're directly to talk to each other. And the whole point of a run is you want to get out ahead of the other people, and you're getting out to get out first. And if everybody's doing that, it's self-fulfilling. I think that institutional investors are thinking other institutional investors sort of think this way, so I better get out ahead of them. Absent social media, people like you and me don't think like that. And once I don't think like that, and you know I do. Once we both know we don't think like that, neither one of us has to worry too much.
Okay, Professor Diamond, the global economy is once again facing steep challenges, and experts are increasingly beginning to say that we might be looking at a recession in 2023. Now, how can banks brace for something like this, and are there lessons that they can dip into from the 2008 financial crisis?
So let me start with the second part. Because of the 2008 financial crisis, banks, independent of changes in regulation, have already pre-positioned themselves with bigger capital buffers over and above the amount they're required to hold. So that's just the bank's own behavior. They have to have X% capital, and they have X plus 3% capital. So that's recent memory of a crisis gives individual institutions incentives to be a little more careful. And probably more important, the regulations have made them hold more capital, which means they have fewer deposits and more equity, so they're a little more secured. So I would say in a lot of the world, the commercial banking sector is in a more resilient state than it was. So that will prevent a pretty small shock from bringing the system down. Obviously, a big enough shock could bring it down. So I think the banks are in better shape. And I think what they have to do now is, if they see that we're going into a recession, which it may be a small recession, that's very hard to predict, given we've never really had this much of a continuing boom around the world in periods when there's already been a bunch of tightening. So maybe we will only go into a small recession, but I don't know. So I think the banks have to think, okay, we have to raise our credit standards a little bit because the default rate might go up. That by itself will tighten things and make the recession bigger. So being more careful and have higher lending standards, being more transparent about what their standards are, so they tell people we're being careful. That's probably what if I was running a bank, which thankfully I don't, I like to be a professor, that would be what I would do.
Professor Douglas, now we have seen a tremendous rise of fintechs in the last few years. Now, does fintechs make banks less relevant? And more generally, what kind of role and presence do you see for banks in the future?
So fintechs, there are lots of definitions of fintechs. Let me define them this way. Fintechs are institutions that do a lot of the things that banks do and did, but using a different platform and using different technology to evaluate borrowers and lenders and things like that. So one of the things I can tell you, the paper that Phil Divvig and I wrote is about how the contracts that whatever institution is the one as the intermediary between borrowers and lenders, it's about the contracts that they write. So the Diamond-Divvig model applies to fintechs just as much as it does to banks. So the difference is banks have regulators to keep them from doing too much risky stuff. They have lenders of last resort, central banks, like all over the world. So my answer would be more and more of this activity, which you borrow short term and you lend long term, and the long term stuff you can't sell at full value, it's illiquid. That has migrated more and more into these unregulated things like fintechs. So that is saying that those fintechs have this same fragility that banks used to have, and banks still have to some extent, to the extent they don't have deposit insurance on everything. So I would say fintechs are the shadow banks of the current time. Shadow banks are the things that do banks activities without being called banks. So I'd say it's an issue. Fintechs have got to look out for them. People have said for a long time, now that we have X, banks are toast. They're going to be done. Now that we have such low bid-ask spreads in financial markets, everybody will always finance all their stuff with equity. We won't have any banks. That was clearly when people were saying that 25, 30 years ago. Now that we have fintechs, there won't be any more banks. That's probably not true either. This fundamental thing in society that there's a profit from borrowing short-term and lending long-term, that's just there. If you make one institution unable to do that, another institution, which what Divik and I in our second paper called replacement intermediaries, now known as shadow banks or fintechs, it's just going to move elsewhere. It's sort of like whack-a-mole. You'd hit one thing down, it pops up someplace else.
Right, right. Now, coming to India, Indian banking sector is dominated by public sector banks. The government-run banks. They control about 2/3 of the market share. Do you think this kind of dominance by state-run lenders are healthy, or is it time the government should privatize its own banks?
So I'm actually, unfortunately, not an expert on the Indian banking system. I can just tell you what I know about the evidence from around the world. That government banks around the world tend to do more sort of politically connected lending than fundamentals-based lending. So that could be a good thing or a bad thing. The bad thing if the political connections are through, your brother-in-law or your party member, and I lend you money for a bad business, that is definitely a thing about politically connected banks. The other thing is that they could be lending to parts of the economy that need more encouragement and development. So that's sort of the trade-off. The good news is that maybe because they don't have to totally maximize profits, if the government has a goal, they can allocate capital a little bit. The trouble is there's no way to leave it at a little bit. Once the government or the government official, even worse, is allocating the capital, you get this sort of crony capitalism of going to your quote brother-in-law. So I that's the trade-off. In terms of the situation in India, I can't really, I'd have to know a lot more to say anything.
Right, right. I have another question, but it's related to the monetary policy making. Now, Indian context, we are heavily dependent on weather, which plays a critical role in price movements. So what would like to know that whether do you think inflation targeting framework for the monetary policy works in countries which are where the external factors are so much influencing the prices?
So it's hard to think if a central bank wanted to have a goal to make sure it didn't let inflation get out of control and inflation expectations get out of control, the most natural target is actual inflation. Now, your point, I think, is a very important one, that if you have things that move prices, this is not inflation necessarily, move prices up and prices down, you can't just use today's inflation, including the goods whose prices move up and down for reasons other than general excess demand in the economy. So if you have an inflation target in such an economy, you need something that looks at that is sort of your own version of core inflation, which is like wages and the prices of these crops that don't so much move around with weather. So you need to try to look at what we call the headline inflation, includes all that stuff, and the stuff that doesn't. And you also need to look at sort of a long run moving average. You don't want to look at just today's inflation. Prices jump 10% and they're going to go down, 12% tomorrow, or if the weather gets better. That's not inflation, that's price movements. It's very hard to tell the two apart. So it's harder to have a really good target if you have these things where it's really depends on weather. Or think about, India thankfully is a well-diversified, very large economy. Suppose you ran a small island economy where half the output depended on one crop. Even if your weather is fine, the price of that one crop could make your inflation move all around. That would be an even worse situation. But you need to do, central banks, you need to give somebody a goal. This is even true if you have an employer-employee relationship. The employer should tell the employee what the goal is to make sure they can try to deliver. So if you want central banks to do their job, you got to give them some kind of a goal. And I think inflation targeting isn't such a bad one, even in India or anywhere.
So are you saying that instead of targeting the headline inflation, one should look at the core inflation for monetary policy making?
Yes, for sure. And I think, I don't know, actually, I know people who know what they do in India. I know some very well. But I actually personally don't know how the monetary policy in India is conducted. In the United States, in the Eurozone, in Japan, this core inflation is really the thing that they use. And like the US Federal Reserve, there's like various measures of the core inflation. They use one that is that takes account of the fact that if the price of one good goes up, you're going to buy a little less of it. And if the price goes down, you're going to buy a little more of it. So when they weight the different prices, they take account of the fact that, when you substitute your spending toward the one whose price went down, that thing gets a little more weight than using the spending you had at the beginning of the period. So both of those things, the core and this thing about which inflation index you use, are designed to get around the exact problem that you're raising. And when it depends a lot on weather, the central bank had better say, well, look, the monsoon was a disaster this year, so we really have to realize prices are going up. We have to communicate to people that's not inflation, that's prices jumping. And unless we have a bad monsoon again next year, we expect prices to go back down. And now that's the US tried that. They talked about transitory inflation due to the lack of a complete end of the COVID lockdown. And that blew up in their face when the supply chains did not get better. And I think you're not allowed to say the word transitory in the Federal Reserve anymore ever again.
Professor Diamond, you have written about the necessity of bank deposit insurance and also about the need for a government safety net when it comes to banking. And a lot of policymakers have heeded that advice. What more can be done to, build customer confidence?
So I think deposit insurance, particularly if it covers a very big fraction of all the deposits out there. So let's say it's big enough so like for household deposits, it covers 90% of them, including the absolute biggest ones, or the people who really put all of their fairly substantial wealth into banks. And it covers a big part of business deposits as well. You're not going to put it to millions and millions of US dollars. I think that is important. Once you've gotten beyond that, you need at least two other things. One, you need confidence building maneuvers for the depositors, so they're pretty sure they don't have to worry about the banks being in fact insolvent. So these things, like stress tests, where the regulators go in, look at the portfolio, and use the regulators' information and the bank's information to think about what kind of macroeconomic or world shocks could bring the bank to a insolvent or close to insolvent position. So having stress tests that people believe are credible and honest, I think that's a very important confidence building maneuver. And the other thing is having a bank failure resolution policy in place that is not tremendously expensive, so it doesn't ruin the bank, and is not tremendously punishing of depositors who are asleep at the wheel and leave their money in. So bank resolution, where you sometimes actually don't have to have the bank fail, the bank becomes insolvent. First, you tell them raise more capital, which is more equity. If they can't do that, then do something like take some of their long-term debt, not their deposits, their long-term debt, and write it down from 100% of its value, say, to 50%. That's a way to force the existing long-term debt holders to recapitalize the bank. Things like that make resolution if a bank gets into trouble, if it means that the deposits are either insured or will be fine even if they're not insured, that's the key. In the post-2008 period, lots of such things were proposed. I know there's things like that in the US. There's something called bail-in in the Euro area. Unfortunately, I wish I was more of an expert on the Indian thing. Like, I don't know what your country has done. But those things about making it less essential to be the first one out as soon as there's anything wrong with the bank, those are the second and third lines of defense after deposit insurance.
Thank you so much for speaking to us, Professor Diamond. It was a pleasure talking to you.
Yeah, thank you. These were very good questions. It made me think. I like that kind of question. Most people ask me what I had for breakfast on the day they called or something like that. So that's less interesting to me. Great. Thank you.
Thank you so much. Thank you. Congratulations again. Bye-bye.
Thank you very much. Bye-bye.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.